Okay, so you've tuned in. Maybe it's because of the title of this particular episode, and that made you click. So let's just address this right up front. Does your advisor really suck? In most cases, the answer is no. Most advisors are not the villains in this story. They're decent people who got into the business to help. But the system they operate in, yeah, that often does kind of suck. It's built around sales targets and product pushes and sheer volume of clients, not around truly knowing you and stewarding your retirement. So, today in the Retirement Income Lab, we're going to put that system under the microscope. We're going to talk about how to tell whether your advisor is a real partner in your retirement or just an overworked salesperson living with a bad model. I'm Patrick Huey, certified financial planning practitioner. Let's get to work in the lab.
You're entering the Retirement Income Lab with certified financial planning practitioner Patrick Huey, where your questions about retiring and staying retired get answered. No hype, no stock tips, just data, discipline, and the right decisions to help you make retirement a reality. You ready? Good. Let's get to work in the lab. Here's your host, Patrick Huey.
So, welcome back to the Retirement Income Lab, where high-saving professionals turn portfolios into paychecks that they can actually live on. If you're within about 5 years of retirement or just getting into it, this series is for you because we stress test real-world retirement income decisions so you don't have to test them out there in the real world on your own portfolio. Now, if you watch today's episode and you think, hey, this sounds like my situation, remember you can always schedule a retirement income lab assessment with me at victoryindependentplanning.com/contact. Now, that link is going to be in the show notes, and I'll explain more at the end. For now, let's talk about why the advisory system, what I like to call Big Advisor, is failing a lot of investors, just like Big Tobacco and sometimes Big Pharma do, and what you can do about it. Now, there's a concept that's not any part of finance or even science. It comes from anthropology, and it's called Dunbar's number. And Dunbar's number suggests that human beings can only maintain stable, meaningful social relationships with about 150 people at a time. Beyond that, names blur, details get lost, and the depth disappears. Now, ask yourself a simple question. How many clients does your advisor actually serve? Now, not the number that comes in the brochure or that's on the website, the real number of total households on their books. In many big firms, and increasingly in some large RIAs or registered investment advisors, it's not 50 or 100. It's hundreds or thousands or even more when you count households. Now, no matter how smart, kind, or well-intentioned someone is, they simply cannot deeply know 500 or 1,000 families, not their histories, their fears, and their goals. And you don't just have to trust me on this. I know because I've been there. I've been the advisor with 1,200 relationships. The system quietly settles for the following. It settles for knowing a small percentage of your clients very well. It settles for knowing a large percent barely at all. And it settles for a whole lot of people somewhere in the middle getting a pretty generic version of advice. Again, that's not because your advisor is a bad person. It's because the business model was built around more clients equals more revenue, not The right number of clients equals the best outcomes. Now, for decades, the dominant model was the big broker dealer or wirehouse. If you've ever watched golf or most other sporting events, you've seen the advertisement from these folks. These used to be advisors paid on commissions. They were product grids and sales goals. They were managers, regional managers, and national sales directors, all in line. And that's a whole lot of mouths to feed between you and the person you actually talk to. Again, been there. It was my first job in finance, working in a relationship like that, where there was a manager, a sales director, and a regional manager, and everybody got their piece of the pie, which meant the pie had to be a lot bigger for the advisor to even eat. And guess what? Clients started to notice. And they'd say things like, well, wait, are you recommending this because it's the best for me or because it's on the sales sheet coming from the regional manager? Well, that question helped fuel the growth of independent registered investment advisors, RIAs, operating under a fiduciary standard. What's a fiduciary standard? Well, it's a legal definition that says they have to work to put your interest first. Not about the commission. It's about making sure your success matters most. What happened was advisors left big firms to serve fewer clients with more planning, fewer proprietary products, and clearer fees because they were stripping away a lot of the administrative drag from these big wirehouses. Now, that was, and quite frankly, often still is, a huge step in the right direction. But now, some of the same volume pressure is creeping back into the independent world. Small RIAs are getting rolled up into giant platforms. Advisors are being handed growth targets and service models where one advisor or service team is expected to manage hundreds of retiree relationships. The labels have changed, but I'd submit that the pressure has not. And for you, the high saving pre-retiree or retiree, that means it's no longer enough to ask, are you a fiduciary? Are you a registered investment advisor? You also have to ask, how many clients do you personally serve? How do you actually serve them? And how will you know when you've hit your maximum? More clients is not always better for the client. So how does a bad system show up in your day-to-day experience? Well, let me give you a few signs. The first sign is that you do most of the chasing. If you're the one calling to schedule reviews, if nobody proactively reaches out about Social Security conversations or Roth conversions or a sensible withdrawal plan, it's a warning sign. If markets are volatile and you get a mass email, not a one-on-one conversation, or at least an offer of a one-on-one conversation, that's a warning sign. If your advisor talks more about products than about your plan, that's a warning sign. If those conversations drift towards the latest fund, the latest annuity, or a model portfolio, not saying that those conversations don't have a place, but if it's always about product, if it's always about performance, and there's very little about tax planning, healthcare, or what a bear market would do to your retirement, warning sign. If you could swap your name with just about any other client and the advice wouldn't change much, that's a warning sign. If everything feels off the shelf, if you're not sure your advisor actually remembers your spouse or your kid's name, or that you want to fund your grandkids' education, warning sign. If things only happen when you push, if you have to remind more than once about actions from past meetings, if tax strategies and estate updates always seem to be on the list for later, Warning sign. Now, again, in many cases, this is not malice. It's just math. If an advisor has 400 plus households, even if they work 60 hours a week, they can't give every client the attention a complex retirement deserves. The system has set them and you up to accept good enough and generic instead of specific and stewarded. So, what should you expect instead? Well, no advisor is perfect and no firm is perfect, but a healthier model has a few common traits. There's a clear client cap. Okay, your advisor can tell you, I work with about X households, and here's my maximum. And they can explain how many new clients they take on each year and why. There's a defined service model for people just like you. The advisor can say, well, for high saving pre retirees and retirees, here's what we do each year: tax planning in the fall, income reviews in the spring, ongoing portfolio management, coordination with your CPA and estate attorney, and so on. It's specific, it's not vague. Then there's planning that goes beyond investments. If they're talking about Social Security timing, healthcare and Medicare decisions, Roth conversion windows, RMDs, estate documents, and charitable giving, not just what the market did last quarter. If they know you, if in a review you don't have to re-explain why you're working until 67, or which child struggles with money, or leaving money to charity and why that matters to you. Those things are written down, they're institutionalized, they're revisited, and they are built into your plan. If you feel like a partner and not a line item, when you email or call, if you get thoughtful, timely responses, not silence for weeks on end. You're not handed off to three junior people you've never met every time you ask a real question. And you're not bumped down a list of junior advisors because everybody at the top wants to work with people with more money. The point is not to demand perfection. The point is to find someone operating in a model that actually allows them to be the kind of steward that you deserve. Now let's talk about the elephant in the room, can we? Now, what are you actually getting for the 1% or so that you pay to an advisor? On $1 million portfolio, 1%, by my math, is $10,000 a year. On 2 million, 20 grand. That's real money. So it is fair to ask, am I getting at least that much value back in dollars, in decisions, and in peace of mind? Here's what value is not. It's not beating the market. It's not picking a handful of funds that you probably could have bought on your own. And it's not quarterly performance reporting in a nice leather folder. A good advisor should be able to explain where their value shows up. In retirement income design, helping you avoid mistakes with withdrawal rates and sequences of return. In tax planning, doing smart Roth conversions, asset location, and RMD, required minimum distribution strategies that can save you tens of thousands of dollars over a retirement. In Social Security timing, coordinating benefits for you and your spouse to squeeze more guaranteed income out of the system. In healthcare and Medicare decisions, helping you avoid gaps and expensive surprises. And in behavioral coaching, keeping you from panic selling at the bottom or chasing fads at the top. And finally, in estate and legacy planning, coordinating beneficiaries, titling, and charitable strategies so your money goes where you actually want it to go. And don't take my word for this stuff. Studies from firms like Vanguard and Morningstar have tried to quantify this advisor alpha or gamma, often landing in the neighborhood of 1 to 3% per year in potential value from planning, behavior, and tax smart decisions. Will you see that value every year in a straight line? Absolutely not. That value tends to come in lumps, a lot here, a little there, over time. But over a 20 to 30-year retirement, the difference between getting that kind of value and getting almost none can be enormous. Among Americans with a financial advisor, 71% feel financially secure compared to only 10% of those without one. But what if that financial security could be even more secure by upgrading your advice and getting more value? Help me. Help me get that number to 100% who feel financially secure and have a financial advisor. Now, personally, I have a client who never thought she needed a financial advisor because her husband was in the insurance business. So why bother? Going on 15 years later, after refining their tax planning and saving them money, growing their portfolios, and helping them navigate three major market downturns, she tells me she was wrong and that the value has far outpaced the cost. So ask yourself, if you're writing a check or silently having 1% pulled out of your account, what are you actually getting in return? Can your advisor answer that clearly in plain English without hand waving about access to our amazing platform? If the answer is vague, you just may be overpaying for under-delivered value. So how do you know, and how do you figure out whether your advisor is trapped in a system that doesn't serve you and whether you're getting value for what you pay? Here are some straightforward questions you can ask, drawn from the themes in my book, The 7 Pillars of Financial Wisdom. And if you want a copy of that book, there's a link in the show notes to download it. Question: how many client households do you personally work with right now, and what's your maximum? Let's get a real number here. If it's 300 or 400 or more, ask how they realistically provide proactive planning to that many people. Question: what does your service model look like for a client like me? How often will you meet? How do you proactively review each year? How do you reach out in volatile markets or when tax laws change? Question: how are you compensated? And are you always a fiduciary? Are there commissions, proprietary products, sales goals? Do they have to act in your best interest at all times or only some of the times? Question: what specific value should you expect to provide for the fee that you pay? Ask about tax planning, retirement income design, Social Security, healthcare, estate coordination, and behavioral coaching. See if the answer goes beyond, well, we manage your investments. Question: when was the last time you told a prospective client, I'm not the right fit, or I'm at capacity? If the answer is never, you might want to be cautious. An advisor who never says no may be letting the business run them instead of running the business. Question: and this is a key one. If I hire you, who else will I be working with? Will you talk to a lead advisor and also a support team? That could be fine as long as it's clear, stable, coordinated, and you know, like, and trust every single person on that team. Or is there a possibility that you're going to be starting over with a new face every 6 months? Now, the advisor who welcomes these questions and answers them clearly is usually not the problem. The advisor who dodges, changes the subject, or gets defensive may be signaling that the business model isn't aligned with your best interest. I've been doing this for 2 decades, and most retirement plans don't fail because of a bad investment. One ETF that doesn't perform to projections is not going to sink a retirement plan. Retirement plans fail because the relationship around them couldn't handle stress. You hit a rough market. You have a health event. or a job loss right before retirement. In those moments, the last thing you need is a product pitch. You need a steward, someone who knows your situation, your values, and the math behind your plan well enough to guide you through it. If your advisor is just a name on a statement or a rotating voice on a 1-800 line, the odds of getting that kind of guidance when it really counts are extremely low. So when I say why your advisor sucks, what I really mean is why the system they're stuck in may be sucking value out of your plan, and why you deserve a relationship and a structure that are built for depth, not just for scale. Now, if you're watching this and you're thinking, I like my advisor as a person, but I'm not sure the system they're in is built to really know me, or that I'm getting the value that I should for the fee that I pay, that's a good sign it's time for a second opinion. Now, I'm a fiduciary. I'm a certified financial planning practitioner, and I'm the owner of Victory Independent Planning. I work with high-saving professionals nationwide within about 5 years of retirement or recently retired. And in a retirement income lab assessment, we can review your current plan and portfolio. We can discuss the service model that you're getting under your current relationship. We can assess if the fee you pay is buying you tax planning, retirement income design, and proactive advice, or just a basic investment selection. And we can show you what it looks like to work with a firm that intentionally limits the number of households we serve so we can actually get to know you. If you'd like that second opinion on both your retirement plan and your advisory relationship, go to victoryindependentplanning.com/contact and schedule a short call today. The link is also down in the show notes. Now, if you found this helpful, please subscribe to the Retirement Income Lab. We'd love to have you as a subscriber. And hit the like button. It's going to help that magic algorithm help more people find these conversations. In our next experiment, we'll turn back to your portfolio itself, and we'll look at how to build a retirement paycheck that can flex with markets without blowing up your plan. Thanks for watching, and I'll see you next time in the lab.
This has been the Retirement Income Lab with certified financial planning practitioner, Patrick Huey. To stress test your own retirement income plan, visit victoryindependentplanning.com/contact and schedule your introductory call today.